Good afternoon, everyone. Today is Monday, the 14th of May, 2012, and this is Brian Shannon speaking from Alphatrends.net. Let's take a look at this market here. It continues to be guilty till proven innocent from an intermediate term standpoint. We still have this declining 5-day moving average, and although the market got briefly above it last week, it was unable to see that moving average flatten out and turn higher, and we were unable to get above a little bit of resistance just under that 137 level. So we remain very cautious in this environment. From the lows that we saw last December, and that's where I've chosen to put some Fibonacci on, we've seen that this market has now retraced almost exactly 38.2%. So this being the full range, this is 38.2%, 50%, and 61.8. The theory behind Fibonacci is that as long as it holds above the 61.8% retracement level, it's still within the confines of a normal pullback. However, that doesn't help us, obviously, from an intermediate term standpoint. You can't just keep buying all the way down. We are at a level where we would expect that maybe there would be some traditional support as well from the lows that we saw in early February. But right now, it's just a game, I guess, of if you're looking for longs, it's a matter of looking for or waiting for the buyers to show that they are going to regain control. What we're going to do here right now is take a look at the volume weighted average price since the beginning of the year. So the average participant is long or short right now at about 136, and you have to figure, well, the average long isn't feeling too good about their position since January 1st, and the average short, which when you think about hedge funds and mutual funds, and that's maybe more important, is they go from a beginning of the year basis that those shorts are in a winning position here. Now, of course, you could take a Fibonacci or a volume weighted average price off the ultimate lows that we saw in 2009. The volume weighted average price way down at 114 and a half. But that doesn't do us any good. What we need to do is look at relevant data that could potentially help us today. And right now, it's a 38.2% retracement and prior support that might offer some, or 38.2% retracement that might offer some support. But there's no sign of that, obviously, yet. Last week we had, of course, this 137 level was acting as resistance. We had that declining 5-day moving average, and again, we bumped above it slightly on Friday, but failed. And when the direction of the 5-day moving average is lower, then it's guilty till proven innocent in the intermediate term time frame. It doesn't mean you're gonna not miss some good trades based on that, but it's a cautious way of looking at the market that's going to keep you in the game and let you realize that there's a lot of destruction going on in this market on a daily basis, and it's better off to just go much slower if you're a long side trader and even short side trader. I mean, shorting, I've mentioned this numerous times. I believe shorting is much more difficult than the long side as far as sticking with a trend and being able to hold. So what we want to see now in the S&P 500 is going to have to get at least back above 135 in that declining 5-day moving average before we can have any faith in any type of bounce. One scenario that sometimes plays out is we have a declining 5-day moving average with gap above it. So if that's to occur here in the next couple days, just be on the lookout for it to, if it can hold above the volume weighted average price that day that it does gap higher. So let's say it gaps up tomorrow to 135 and a half. Doesn't seem likely, but just for making a point purposes, it might run to 135.75, pull back to 135 and a half, and at 10:30 a.m. Eastern. So an hour after the market's open, the volume weighted average price might be 135.75 for the day tomorrow. So just that first hour, basically. If it's to get back above that volume weighted average price and hold above it, there's a possibility we could see a move like this that does continue to go higher. That is a very low probability trade. I'm just trying to point out that what we always need to do is remain flexible in our opinion of the market and listen to the message of the market. Don't listen to stuff like, well, Carl Icahn might be buying Chesapeake. Carl Icahn could buy all he wants of this stock, but it's in a downtrend, and there's plenty of people offering that one group some liquidity there to buy what they want, because other people think the consensus is it's a damaged stock and it's in a downtrend. You can look at, well, the earnings were good for for Green Mountain Coffee Roasters, if you want, or whatever. But their own chairman is getting called out. Margin calls on this. Even the biggest players and the CEOs make these mistakes. And the point is, we've got a lot of risk in this market. We've seen tremendous damage today. There was ACOM. You've got Broadsoft. You've got Cisco, and these stocks, like Herbalife and New Skin, they just continue to get pounded day after day after day. Don't listen to the wonderful stories about Westport Innovations or Mako or whatever they are. They gap down and they just continue to get pummeled, and that's the environment we're in. It's why we have to remain very cautious and risk adverse. The volume weighted average price for the Nasdaq year to date is approximately 64.09. So the sellers, we're battling in that area. We're also right at about that 100-day moving average, and we could draw some Fibonacci on here if we wanted as well, and say, maybe since this low, a 38.2% retracement would take us down to 63, about 62.75. The point is, though, the main point is that we had some support in this general area last week, 64.75 to 65. That prior support had acted as resistance later in the week, and we're breaking lower with a declining 5-day moving average. So it remains guilty till proven innocent. Now, we're still within this little range, but you look at the rest of these markets, it's hard to imagine that it's going to stick, be able to hold up. The Russell 2000, we've had our first close in a while below that $78 level that we've had our eye on, and of course we've been below that volume weighted average price for a while. So if we can't quickly recover back above the $78 level, then what we have to look at in the Russell 2000 is perhaps we're going to move down even towards the 200-day moving average, which is let's just take a closer look in here. The 200-day moving average down at about $75 a share. The point is, there's potential support, and we broke that little level of support. You could call this a head and shoulders pattern if you wanted to, and measure the height of that, which is basically 5 points, which would indicate a price objective down towards 73. And that might in fact be where this market goes, but you can't use that to manage risk. Obviously, we were above that 5-day moving average last week, but we never got above the resistance. The 5-day moving average had an opportunity to flatten out, and what we were looking for today was the potential of a movement like this. But obviously, the market gapped lower, and that's why you have to be aware of what the different scenarios are. If you have long side setups for the day and they don't trigger, well, there's no point in taking them and fighting the trend. Listen to the message of the market. It speaks to us. And the semiconductors were briefly above on Friday, a declining 5-day moving average, and that 33 level, which has been important. But the sellers are coming back in once again here. So we still have a pattern in these markets of these lower highs and these lower lows. So they remain innocent till proven guilty. Financials broke that $15 level, $14.95, whatever you want to call it, and they continue to break down and look like they're headed towards $14.30. So the market has been adhering, the markets have been adhering pretty well to support and resistance levels, and when they break, you have to take them seriously and look at the direction of these moving averages, the declining 10, 20, and 50-day moving average. Obviously, the financials got some news from JP Morgan that really helped squish them. And it's ironic because the JP Morgan, they said they were buying back shares over here, and that's why the financials lit on fire that particular day, the XLF. This is the day that JP Morgan announced that. Now they're giving us bad news. The point is, though, we're in a risky environment. Realtic has the tools to allow you to manage that risk, and this video is brought to you by Realtic. Check them out at realtic.com. I appreciate your tuning in here. Don't forget that I have a premium subscription site where you can get this analysis every day, as well as a midday video too. Thanks for tuning in.